Welcome, my name is Marty Schenkman, and I'm joined today for this video clip on defined value mechanisms, and we'll define what that is with Jonathan Blattmacher. So let me just kick it off by describing what a defined value mechanism is. A taxpayer is going to sell assets to a trust.
Or give them to a trust.
Or give assets to a trust, or to anybody, frankly. But let's just keep it as a trust to keep the example simple. And they believe that asset is worth $10 million because they went and had it appraised for that number. They're legitimately appraised, and that's the value they think it is. But there's no certainty that the Internal Revenue Service may not come in on a gift tax audit, for example, and say, wait a minute, that value is incorrect. It's really $20 million, not $10 million, and now you've made a $10 million taxable gift, assuming you've used up with that $10 million transfer all of your gift tax exemption, or if you've made a sale and you have no exemption left, you've created a taxable gift. So the concept of a defined value mechanism is to deflect, to avoid a gift tax on a transfer that you intended to make at a specified value. You want to talk a little about some of the general things, then we'll get into some.
Yeah, let me clarify what it means. So you've now got an appraisal for $10 million for this asset. Let's say it's a business, and you want to sell it to a trust or give it to a trust, but you say, you know, I'm willing to do this if it's a $10 million value, but not if it's more. So what you do is you say, I am now transferring or selling the lesser of 100% of my ownership in this asset, or that interest which is currently worth $10 million. Now, if the IRS comes in and says it's worth $15 million rather than $10 million, presumably all other things being equal, you will have transferred only 2/3 of the asset. But it would mean that you've retained 1/3, but you won't have made a taxable gift of the $5 million difference.
Correct. And when we go through some of the mechanisms that are used, of which there's lots of different views on, and we'll try to cover a few, in some instances it's not retaining that excess value, but having it transferred to another receptacle that is not subject or creating a transfer tax.
For example, to charity. And by the way, let me give you a little background. All estate planners know, because they do this virtually every day for their married clients, that you say, I'm going to transfer the assets, and it's basically going to go, when I die, into two broad buckets.
You're talking about a typical dispositive scheme.
Typical dispositive scheme.
All the time.
All the time. And I'm going to transfer the amount of my unused estate tax exemption to one trust, typically called a bypass trust or a credit shelter trust, and the balance I'm going to have to go to my spouse, either outright qualifying for the marital deduction, assuming that he's a U.S. citizen, or in a form of a marital deduction trust. But no matter what the values are, there should be no tax paid. And indeed, the IRS has conceded that. And that's basically what you're doing when you have that gift over. So you say, okay, I'm going to transfer $10 million worth to this trust for my descendants, or sell $10 million worth. And the balance, and you basically have a number of choices. One is to say the excess is going to go to charity. And there's a case decided by the courts called Christensen, where the court said that's fine. If there's excess value and it goes to charity, we will accept that, just like you have the marital trust and you have the credit shelter trust, and that was upheld. So one is to have it go to charity.
Right, but the problem for a lot of clients is that while they may be very charitably inclined and may be willing to give a fairly significant amount to charity, they're not going to be comfortable giving the majority or most of a family business to a charitable beneficiary.
It may not even be a family business. It could just be that much wealth.
Correct.
I don't, if the service comes in, I don't want to make a huge gift transfer, even if it's not subject to tax, to someone else. So what can you do? Well, one of the other options is to create a grantor retained annuity trust, where you can make the value where you can make the value of the taxable portion extremely small, and we could discuss that in some detail. But maybe you make it 1%. You say, I'm going to have the annuity payments equal 99% of whatever is the final gift tax value of what I'm transferring to the trust. So
a nearly zeroed out grad.
A nearly zeroed out grad. So you say, okay, $10 million I'm selling to this trust or giving to the trust. Any excess value is going to go into a grantor retained annuity trust. And when you do a proper grantor retained annuity trust, the annuity that the creator of the trust retains is not subject to gift tax because there is in effect no transfer. It's only that tiny value of the remainder, which is the gift. And as a consequence, you are going to avoid any huge gift tax, assuming that that works.
Let's make a couple of comments about the use of a GRAT and a spillover. Some practitioners like the use of a GRAT because they feel it's sanctioned by regulation and therefore a fairly solid approach to use. Others raise concerns that GRATs are very difficult vehicles to assure that you're complying with. So for example, a GRAT can only have one contribution. So if there's a adjustment, is that yet a second contribution that becomes problematic?
Well, one of the things that you can do with that is to say no additional contribution can be made to this trust. And if there is a contribution made or deemed made, it shall be held in a different but identical trust to this one. So you can draft around that possibility, and that's obviously something that practitioners should do.
And another piece of that is that you can use the same transfer instrument so that at the date, at the time that a gift is made to the GRAT, say 1% of the company, or 1% of the value of what you're doing, some gift, so it has skin in the game, you can have the excess value, if there's a valuation adjustment due to a gift tax audit, transferred pursuant to the same instrument at the same time. And on your Schedule A or whatever you append to the GRAT in terms of the assets listed, list that adjustment as well as the initial interest. So the argument is that if there's a later valuation adjustment, that's part of what you transferred in from inception.
Right. A couple of other alternatives you have is to have the excess go into a marital deduction trust for your spouse. Now, again, do not use a Q-tip.
Explain why, because that may be of interest.
Well, again, this gets us back to the basic structure that practitioners do almost every day for their wills and revocable trusts for their married clients. You're going to have an amount go into the credit shelter trust equal to the unused estate tax exemption. In this case, it's not going to equal the exemption. It's going to equal $10 million or $5 million or whatever you're willing to transfer, and to say that that's a taxable transfer. But the balance, just like you would in your will, saying anything above my unused estate tax exemption goes into a marital deduction trust. And that's exactly what you do here. Now, the service has kind of pushed back a little bit on it, but I can't see how it can argue that you can't have a marital deduction gift go back. Let me warn you, however, do not make it a so-called Q-tip trust. You don't want a Q-tip trust because of now Section 2519, which says if you ever give away any part of the income, you've made a taxable gift to the whole thing. But you can have it go into a general power of appointment trust in which the spouse is entitled to all the income, and that should automatically qualify. So if the IRS comes in and says that transfer you made, which you said was worth $10 million, was actually worth $25, well, the extra $15 million goes into a marital deduction trust, and you will avoid gift tax.
So let's recap. So one could spill over to a charity. Two, we talked about spilling over to a nearly zeroed out GRAT. Three, we've talked about a marital deduction trust.
And there's a fourth option.
I know, your favorite.
My favorite, which is an incomplete gift trust. Now, again, if you've got a happily married family, it may not matter whether you have it go into the marital trust, again, a general power of appointment trust. You don't have to worry about the crazy rules for Q-tip trust, but you could have it go to an incomplete gift trust. In fact, you'd say any excess above the $10 million goes into trust number 4, and trust number 4 will have the following
like
provision.
Monty Hall.
Well, it kind of is.
The tax version.
It basically says that the only beneficiary of this trust number 4 is the grantor of the trust, and he or she has a special power of appointment over that trust upon death. And if you look,
His estate,
which
an incomplete gift.
and you want to write this down, it's Treasury Regulation 25.
Can we tattoo this on the other side?
Well,
of the
maybe
gerbil?
it should go because it's very important. 25.
The gerbil is discussed in another video clip.
25.2511-2 paren B close paren fourth sentence, which basically
Gotta get a life
says
to remember stuff like that.
if you make a transfer to a trust of which you're the sole beneficiary for life, even if you're not entitled to anything, you're the only eligible beneficiary to receive anything, and you have a special power of appointment to appoint it among a class, say your kids or whatever, when you die, any transfer you make is incomplete. So again, the first $10 million is taxable, you've agreed to that, or you're selling it for $10 million. And the balance is going to go into one of those four alternatives.
When you do the incomplete gift trust, you also like to leave a little on the table in terms of a tax slice?
Well, that's something, Marty, which can be debated. There are people in the IRS who say, because you are preventing us from collecting any tax, this can't possibly work. And there's a case in the Fourth Circuit decided in the 1940s called Proctor, where you could possibly contend that that's the answer.
So a lot of the techniques, like we've talked about, you can leave a small slice on the table.
Yes, you can leave a
that
slice on the table
if
if you want to.
Is that the service calling it?
That was it. They want me to come and lecture to them.
So you didn't include a fifth, and let's do a fifth and then wrap up. The fifth technique, or a final technique, is the King price adjustment clause. And I do remember you and Mitchell Gans yelling at me because you didn't like that I wanted to use it on a transaction, but a lot of practitioners feel quite comfortable with it. So let's just discuss real quickly what it is so it's also on your radar screen. I'm selling a interest, say, in a business to a trust for the same $10 million we've been using in our examples. If the IRS comes back and I'm getting a note for $10 million from the trust, if the IRS comes in and says, no, it's not a $10 million value, it's a $15 million value, the way we create the note the trust is giving me, the note would adjust to the $15 million so there is no gift. And you didn't love that approach, although some practitioners think it's a very viable
Well,
approach.
there is a bit of a history here on these are known as price adjustment clauses. So you adjust the price if it comes in that the final value for tax purposes is different. And again, the IRS doesn't like these because of the Proctor case or whatever, but most of the cases which have been decided are bad. Now, in the King case, they said, no, we will respect the price adjustment clause, but they did it on the premise that the family did not want to make a gratuitous transfer, and they therefore deemed the transfer to be for full and adequate consideration.
Which is something you can recite in your in the instruments
Correct.
making the transfer, what your intent is, although that could be viewed as self-serving. One of the things that I do like, and then we're going to close on the King price adjustment, is in the non-estate planning world, in the real business world with unrelated parties and closely held businesses, price adjustment mechanisms are often really used. So let's just wrap up. So we've talked about what a defined value mechanism is using nearly zeroed out GRATs, charity, non-Q-tip power of appointment marital trusts, and King price adjustments.
And incomplete gift
and
trust.
incomplete gift trust, your favorite.
Mm-hmm.
Thank you for joining us, and this discussion was for education, hopefully entertainment, and not for us giving you any tax or legal advice. Thank you.